Why liquidity matters. Liquidity is your ability to convert an asset into cash. And the quicker that you can change an asset like real estate or a stock or a bond into cash, the more liquid that asset is. And liquidity is a great resource for any investor who needs to meet their cash flow obligations because it gives you consistency and predictability to convert your assets into cash so that you can use them in your business. So liquidity is a very important component of any asset allocation because it's going to give you the ability to know how long will it take if I want to sell off an ETF or an asset and use it for payments of bills or payroll. How long is that going to take? Your liquidity is going to be very important for you when we look at your asset allocation because it's going to allow us to know how long does it take if I sell an asset today and I want to use that cash for any obligation. What period of time should I plan for? So let's go through an example to understand how liquidity works a little bit more. Liquidity measured in real estate is very, very low, meaning that your real estate asset is not very liquid because that asset has to be sold and then it has to be transferred. And that process sometimes can take 30 to 60 days, depending on all of the different aspects to that sale. So we wouldn't consider an asset like real estate very liquid because it's going to take a long time for you to sell that real estate and to get the cash that then you could use in your business or in your daily life. But an asset like a money market fund or an ETF is more liquid because odds are you can sell that asset today and you will be able to convert it from that ETF into cash. Now, the only delay there is how long does it take to get the money from your brokerage account or your IRA into your checking account so that you can take it from an investment and use it as cash. So liquidity is very important for your overall asset allocation, especially during a period of rising interest rates like what we see today in the United States. As interest rates increase, we have seen an increase in defaults and an increase in bankruptcies. And that means that those assets, whether they be commercial real estate properties or businesses, are no longer valued in the same way. And many investors believe that they had liquidity because of the rating of those assets. But when they actually went to convert the asset into cash, that is going to be challenged because not everyone is going to be willing to pay whatever the market value is. Many investors believe that the value of their asset, like a commercial real estate property, is worth more than what it is actually worth in cash. So understanding how liquid your investments are is a great exercise for you to go through in this time period because as we have seen rising interest rates increase, we have also seen the value of some assets decrease. And not all of the values are reflected accurately in balance sheets. If you look at many bank balance sheets, we see that they are still marked to the value that they purchased the asset. And the challenge with that is that that might be the value that the bank believes that it's worth. But when you go to sell it and to convert it into cash, we're seeing that many times those assets have to be marked down in order to become liquid. So if you are an investor and you're looking at your asset allocation, especially if you're in retirement, you want to be aware of your liquidity because your liquidity is going to determine how quickly you can convert an asset into cash and use it for your life. And if you are allocated to bonds or to real estate, this is going to be particularly important because your ability to convert that asset into cash is going to be dependent on the market price. If the market isn't willing to pay the price that you expect, then your liquidity could be compromised because you may need to sell additional assets. So looking at your liquidity is going to help you with predictability around your ability to convert an asset into cash and to use it to fund your business or your lifestyle. Liquidity is a focus for many investors. It's being overlooked, but what you are going to see over the next few quarters is that it will be a top priority for many investors as rising interest rates compromise the value of assets going forward. My name is Nathan Garcia, and if you have any questions, reach out to me on Pocket Plan. Thank you.